Thank you all very much for being here, and thank you to Jordan and Wyatt. I'm so pleased to be here in Denver, and this is my first time here at the space. It's a terrific facility. It is so inspiring to see places like this and similar ones across the United States. I'm sure many of you have been to the Commons in Austin and Bitcoin Park in Nashville, PubKey in New York, the new PubKey in Washington. And now with this, I'm just thrilled to see this community grow. Maybe just to start with a little bit of interactivity, how many people would have rather had $130,000 Bitcoin for today's conference? Yeah, and how many people have bought Bitcoin this week? All right. How many people have sold Bitcoin this week? I mean, it's an interesting, I'm sure that maybe someone has, I don't know, but maybe not. Maybe everyone is being perfectly, transparent, and actually no one in this room has sold Bitcoin this week. Bitcoin has demonstrated very strong performance, but it has had significant drawdowns basically every year in its history. This is as of, I think, May 31st, so it's a little bit outdated, but the gray bar is the annual Bitcoin performance for that year, and the dark gray bar was the maximum drawdown for that year. And so even in years where Bitcoin has performed extremely well, there have been periods where it was very much white knuckle, right? Very much calling the whole hodl mentality forward. And when you look at Bitcoin, I was once talking to one of our investors, and they said, well, you could do this loan structure, which I'll go into in a moment, but you could do this loan structure with Bitcoin, but couldn't you do it with Ethereum? Couldn't you do it with gold? And I said, you could do it with gold. And they said, well, how would that have performed? And I said, I don't know. So we went and we did a little bit of research, and we plotted every 4-year hold period since the November 2012 halving across all of these different assets. So basically what you're looking at here is you're looking at annual compound growth rates, CAGRs, and the concept is you buy the asset, for example, October the 16th of 2021, and you hold the asset until October 16th of 2025. So that would be one 4-year period. October 15th of 2021 through October 15th of 2025. That would be another 4-year period. So if you start that in November of 2012, which was the time of the 2012 halving, November 28th, there have been through, this data here is through June the 30th. We haven't yet updated it for the September quarter. There have been 3,137 4-year holding periods. You could have bought Bitcoin on one day, put it in a little safe, held it for 4 years, and not looked at what happened until 4 years later, open up the safe, see what happens. 3,137 distinct 4-year holding periods. Of those, the very worst that you would have done in the Bitcoin is you would have made 7.1% per year. Interestingly, that's actually like right about now. We registered that low, I believe, in January of this year. Because in January of this year, it would have, hearkened back to January of 2021. Already Bitcoin was at like 40,000, and January of this year it was like 75,000, and that was the 7% per year compound annual growth rate. That is the worst. And so if any of you are class of 2020 or class of 2021, and you feel good about the gains that you have already managed to achieve, I would like you to reflect upon the fact that these are the worst gains in Bitcoin history. And that could give you, I think, actually a good reason to feel even more optimistic about the future. Because, of course, when you think about adoption, when you think about utility, when you think about the backdrop of macro, there are a million reasons to suspect that the best years are in front of us and not behind us. But by the time you get to this single worst outcome is actually new. Up until January of this year, when this was violated, it was 23.37% per year. So this is a big reduction for the single worst outcome. At the 10th percentile, Bitcoin has produced 31% compound annual growth rate. So what does that mean? That means that 310 periods were worse than 31%, and the difference, which would be what, like 2,800 periods, were better than 31%. The 25th percentile is 48.5%. The 50th percentile is 86% per year. Bitcoin is a very well-performing asset. Compare this to gold. I don't know exactly what dates the single worst gold or silver outcome occurred because I haven't studied it as carefully. But if you did do the single worst gold hold period, you would have bought gold on one day, you would have held it for 4 years, and if you look back, you would have actually lost 10% per year. That would have been your worst experience with gold. And as a matter of fact, in 25% of all of these periods, you would have basically broken even. You would have made 1.2% per year or less. 25th percentile is 1.2%. Silver, 50% of all of the periods, you would have basically either broken even or lost money in dollar terms in silver. The NASDAQ has performed well, but not nearly as well on the upside as Bitcoin. The FTSE has had negative performance on the downside. Apple and NVIDIA, we just cherry-picked two phenomenal stocks, and you can see that they have underperformed Bitcoin. U.S. real estate tips cash. So why? Why are these things happening? Well, Bitcoin is finite. We all know there's 21 million Bitcoin. Gold is not finite. Gold grows by about 1.5% to 2% per year due to new mining. And I believe that that number is poised to go up because of many different factors. Mostly gold price motivates more mining. Also technology. Who doesn't think that AI is making everything easier? It's making everything easier. Shouldn't it also make hunting for gold easier? I think that that's very likely. And how about robots that go digging for gold? Won't they do a better job than people that are using mechanical tools that are not robotic? I think they probably will. And if you think about gold growing at 1.5% to 2% per year, let's say 2%, plus there's also gold on the seabeds, there's gold harder to reach places, maybe there's asteroid gold, maybe there's synthetic gold, like there's synthetic diamonds now. Is it really so implausible that we could not have synthetic gold? But if it grows at just 2%, on the rule of 72, that means that in quantity it doubles every 36 years. So 36 years ago was 1989. That year is a very special year for all of us because that's when Taylor Swift was born. And if you knew Taylor's parents and you congratulated them and you said, "I am so happy about the birth of your daughter, Taylor, and I'm going to place this ounce of gold in your hand and ask you, put this in your drawer and give it to her when she's 35 years old," it's true that the dollar value of that gold would be way higher, right? I don't know, what was gold in 1989? I don't even know. Let's say 200. Now it's $4,400. So you might be like, oh, wow, that was a really generous gift from my friend over here. But as a matter of fact, in gold purchasing power, it's half as much. It's already been reduced by 50% as a percentage of the gold network. And if you held it until Taylor and Travis have a baby and that baby becomes 35, which is a crazy thought, then it would be 25% of the gold purchasing power and 12.5%. It gets halved every 35 years, and that's at the current growth rate. So, gold is not finite. Silver is not finite. Stock is definitely not finite. When it's doing well, management dilutes it. Bitcoin is also scarce. Not only is it finite, but there's not very much of it available. So much of it has been held. I'm sure all of you have seen. Once it's held for 6 months, it's very unlikely to be sold. It's secure, transparent. You can look at the whole blockchain, decentralized. That's really a powerful element. It's under no one's control. The halving doesn't happen because a board of directors decides, okay, let's authorize the halving. It just happens according to code. It's programmable, which is an element that I think is hardly been explored, but will be over the course of the coming years. It's fungible. No Bitcoin is different than any other Bitcoin. Bitcoin in Dallas is the same as Bitcoin in Denver, is the same as Bitcoin in Djibouti. And you can't say the same about anything else. Gold, a silver eagle is different from a Krugerrand, is different from a maple leaf, is different from a Vienna Philharmonic. Also, wine, you might even have the same vintage, but depending on how it's been stored, it could be vastly different value. Real estate is not fungible. This building is worth a completely different amount than the building across the street, even though they're so close. It's not portable real estate. Neither is silver or gold. Really, it's very heavy. Bitcoin is weightless. It's divisible. You can, divide it right now into units that are 1/12 of a penny, and it could be divided into more in the future. It's universal. It gives everyone the same terms from an ESG point of view. That's very interesting because a lot of people talk about governance and they say, if you're a big wealthy person, you get treated better than you do if you, have a very modest amount of assets, but not with Bitcoin. Everybody who engages with the Bitcoin protocol has the same exact treatment. The Bitcoin doesn't know if what your skin color is, what your religion is, your sexual preference. It doesn't know any of that. It treats you the same way. It treats you fairly, and it is accessible. And for those reasons, I think it's poised to continue to appreciate. Okay, so what are we doing with Bitcoin? We are on a mission to improve credit returns. Credit is a very important element of our society. It is the basis on which pensions fund their current obligations to public workers. It's the basis on which insurance companies make enough money to pay current losses. It's the basis on which endowments and foundations support important research and art and other charitable activities. It's the basis on which families afford their current needs. Income is very important. And so you have loans. Loans are where someone is willing to exchange a large amount of capital today for a periodic payment over time. Makes sense. What's the problem? In an inflationary environment, getting paid back your money is an erosion of value on a real basis. If you make a $100 million investment as a credit allocator for a pension in 2015, and you get back $100 million in 2025, you are way behind on a real basis. And that means that our pensions, and all of us should care about that, are badly underfunded. At a minimum, we should care about it for selfish reasons because it's going to require much greater tax support. In fact, in Illinois, 20% of the state budget in 2024, I think, was dedicated to a pension stabilization payment. That's a huge amount. And so people are leaving Illinois, they're leaving Chicago. That's not right, that's a problem. And you might also care about it because it's better to support the people that are firefighters, police officers, teachers, and everyone else that has contributed to our society. And maybe there's some of them are your relatives, because I have some that are my relatives as well. A traditional lender, they get repaid, but they have that capped upside. They get the repayment, they get the income, and they have a single piece of collateral as their security, which has idiosyncratic risk. What we are doing is reframing that by integrating Bitcoin into the collateral package. That means two things. Number one, it means that we're going to have shared upside, and that's way better from an inflation point of view. Let me come back to that. Because number two, and this is probably the first point for a credit investor, is we have better downside protection. If something goes wrong with a loan, any loan, you need to collect against that particular asset. You need to collect against that apartment building, that commercial office building, that business. It's idiosyncratic. You need to find somebody who wants to step into that specific asset. That's not easy. It's not divisible. It is not liquid. That's why banks have workout departments, and that's why it takes them usually 12 to 18 months to work out a problem loan. We have that collateral in our loans, but we also have Bitcoin. And that Bitcoin depressurizes a recovery in the event that there's a default under the loan. It depressurizes it because historically it has tended to appreciate in value over the medium run. We looked at that just a second ago. That means that our loan to value is going down as time goes on. We have more collateral values supporting our loan, but additionally, its characteristics make it easier to recover against because it is liquid, it is divisible, it is fungible. You can depressurize the recovery with the Bitcoin. Beyond the downside protection, we share in the upside of the Bitcoin over the life of the loan with our borrowers. Just like any loan has customized terms, this is a customized term. It's not one size fits all. One credit might motivate a higher interest rate or a higher LTV or different covenants. In our loan, we'll assess the characteristics of the borrower and decide what is the right upside sharing, but we operate on a general principle, which is that borrowers can prepay the loan whenever they want with no penalty. We want to let them have the freedom to refinance at any time. It's a free world, and we support that. But the earlier that they repay, the bigger the share of Bitcoin upside to which we are entitled as the lender. And the longer they stay in the loan, the more of the Bitcoin upside they vest into as borrower. We're incentivizing our borrowers to stay in our loans for the long run because we have a very constructive long-term view on Bitcoin. We want them to stay in the loan. We're happy to take a lower share of the Bitcoin upside. And we also think that the interest that we get along the way will have de minimis credit risk as that Bitcoin appreciates. So we think that we're getting a very favorable current return over the life of the loan. We completed the first loan of this type in about a year ago. This is an asset in Philadelphia. It is a 63-unit apartment building. It is located at 3rd and Chestnut Street in Philadelphia. It is 3 buildings from the 1900s that were, from the 1800s, the 19th century, that were combined internally to create loft apartments with exposed brick and architectural windows and wooden floors, not so different from the room that we're in right now. There are 3 commercial spaces on the ground floor. The sponsor has owned this asset since 1997. It's been a very well-performing asset in a neighborhood with a lot of restaurants, boutiques, parks, nice area. And they had a $9 million loan on the property. So what we did, this is just where it's located. By the way, it's located delightfully. It's located a half a block away from the First Bank of the United States. Which is great symbolism. The First Bank of the United States is right here, right here. And the Second Bank of the United States is right here. And the Federal Reserve is not called the Third Bank of the United States, but it is actually the Third Bank of the United States. And so the first 2 headquarters are right there within 2 blocks of this asset. Independence Hall is right there. The loan terms was a $9 million loan that the borrower had with the bank. And we did a $12.5 million loan. And the use of proceeds was to pay off the $9 million bank loan. We then provided the borrower with $2 million of CapEx facility to make routine improvements to the property, such as replacing the cabinetry when the units turn over and redoing the carpet in the hallway, stuff like that. And then with the remainder, which was $1.5 million, we bought Bitcoin at the time of the loan closing. And that was around 20 Bitcoin because Bitcoin at that time was just about $76,000. And our collateral for the loan is the combination of the building and the Bitcoin. So we have one loan and it's secured by 2 assets, the building and the Bitcoin. Our day one LTV, therefore, was around 64%. We provided an interest rate, starts off at around 6%, drops down over time, 5.7% on average, 5 years interest only. It covers at a 1.4 times debt service coverage ratio. And now what is amazing about this is when you look at these multiples on invested capital and the IRR. Now, what does this not outperform? This does not outperform Bitcoin. It is not our goal to outperform Bitcoin with these arrangements. What our goal is to dramatically improve credit returns because 30% of large pensions are allocated to credit. 30% of insurance companies are allocated to credit. And when you think about that phrase, everyone gets Bitcoin at the price they deserve, it's in a certain sense, it's very true. But in another sense, it's not really true, because you have these professional fund managers that are overseeing the pensions, and the people that are actually benefiting from them, it's not like they're deciding what allocations to make. And so from my point of view, it's important to be able to deliver products that are better performing. I looked at the long-term performance of one prominent pension's private credit investments over the course of a 25-year period of time. They released a report that summarized 25 years of successful investing in private credit. And the two best performing funds, the best performing had a 1.77 times multiple on invested capital, and the second best performing was 1.76. Number 1 and 2 over 25 years. What we're talking about here is at a 30% Bitcoin compound annual growth rate, which is the 7th percentile of historical Bitcoin performance. If you look at it over a 4-year hold period, we're at a 2.1 times multiple on this instrument. And at a 45% CAGR, which is just the 22nd percentile, we're at a 3.6. So you can see that the outperformance relative to conventional credit, Bitcoin fixes this. Bitcoin fixes this. It also delivers to the borrower a superior package. We have given this borrower a tool to redenominate the equity in the asset that they know and like, in part, out of fiat and into Bitcoin. That's way better for them. They're now holding their equity in this building that was built in, there are 3 different buildings, but one of them was in the 1840s, one of them 1860s or whatever. They're holding their equity in this building now, in part, in Bitcoin. And that means that when they go and they sell this building, to the extent that they do, in 5 years or 10 years, of course, if the building appreciates, they get all of that dollar appreciation. But they're not just holding that equity in dollars, they're holding it in Bitcoin. So they get the Bitcoin performance as well, split between us, the lender. That's way better for them. Able to deliver more favorable interest rate, more favorable amortization schedule, more favorable interest-only period, more favorable prepayment penalties, which is to say no prepayment penalties. And if the Bitcoin goes to 0, it's not really such a big deal. It's like a 50 basis point difference from the borrower's point of view compared to a conventional loan. So how has this loan performed since closing? This is also as of June the 30th. I'm sorry to say that the Bitcoin price is right back to where it was on June the 30th. Giving this presentation recently, I had the ability to say, actually, these numbers are not as good as they stand right now, but now they're exactly on the money. So the loan to value has gone from 64% to 62%. That's remarkable because we're in an interest-only period on the loan. And the property has improved its net operating income because they've been able to renovate some units and command higher rents. Since we announced this loan, we have received an enormous inflow of borrower requests. We've received requests related to office buildings, logistics assets, storage facilities, other multifamily assets, businesses of every different type, power assets, everything that you could imagine has come to us because I believe that there is an extraordinary amount of resonance in the entrepreneurial community with Bitcoin. People that have already chosen to invest and save in Bitcoin are asking themselves, how can we integrate more Bitcoin into our lives? And one of the main spheres through which you could do that is your professional life. But hitherto, if you ran a real estate company or if you ran a project finance loan fund or equity sponsor, you didn't have the ability to add Bitcoin. That's the mission that we're focused on, is to give those professionals a tool to add more Bitcoin. The other side of that is to give Bitcoiners the mechanism to realize some of their physical ambitions now. Because, if you have Bitcoin, you are confronted with the decision, do I sell the Bitcoin and pay the capital gains and use it to do this other thing that I want to do? which also means that you have the opportunity cost of missing Bitcoin's future performance? Or do I delay this other thing that I want to do until Bitcoin does X? And everyone, that number might be different. If your basis in Bitcoin is $2, maybe X is high enough at 110. But if your basis in Bitcoin is 25,000 or 40,000, maybe you'd like to see the Bitcoin go to 400,000, or maybe you'd like to see it go to 1 million before you say, okay, I can exit a portion and do this thing. But the problem is that although Bitcoin is immortal, we are not yet anyway, and therefore there's a time preference question. And the longer that you defer this desire that you have, the less time that you will have to enjoy the fruit of that activity. And so what we're saying is we can address this in the sense of somebody can bring Bitcoin into the collateral structure of a loan. We can extend the fiat that's necessary for them to accomplish whatever their goal might be, to buy a business, to renovate a building, to do whatever it is that they want to do. And as long as the ratio of the Bitcoin in the structure is right, we can create financing terms that are very attractive critically without mark-to-market risk. Critically without mark-to-market risk on the Bitcoin that enables a borrower to pull forward some of the tangible enjoyment of having this very powerful savings tool in their portfolio. So with that, I'm just going to read these important risks related to Bitcoin and digital. No, but in all seriousness, thank you all very, very much for the time here. Thank you for hosting me. It's an honor to be here, and I'll be here for the rest of the day, so delighted to speak to anyone.